Okay, well, today we're going to talk about Chapter 15, which is on dividend policy. And I should note that this is the last chapter of the semester, so congratulate yourself for making it this far. The purpose of this chapter is to talk about whether or not a firm should pay a dividend, and if so, how much of a dividend should they pay. Now, very much like with Chapter 16 on capital structure policy, ultimately, we don't know the answer to that question. And perhaps dividend policy is even more confusing than capital structure theory. So I wanted to start off here with a couple of quotes that I think kind of give you a taste of the problem here. So Allen, Bernardo, and Welch said that although a number of theories have been put forward in the literature to explain their pervasive presence, dividends remain one of the thorniest problems in corporate finance. And Black, in 1976, said the harder we look at the dividends picture, the more it seems like a puzzle with pieces that just do not fit together. So those quotes pretty well sum it up. Ultimately, we have a few theories, mainly three, but there's some other things going on as well, and they all disagree with each other. So we don't know the answer to this question. Now, for this chapter, what I want you to focus on are the three main theories. And because of that, that's all I'm going to cover in this lecture. And so it's going to be a fairly short lecture. So why do firms pay dividends? Well, the main reason is because both creditors and equity investors in the firm demand some kind of a return in exchange for providing capital to the firm. And so the question really is, how do you pay that return? Well, the creditors have a contract that promises a certain return, that is, interest and ultimately the repayment of the principal. Now, by the way, let me point out that the interest is a return on the investment, and the repayment of the principal is a return of the investment. Those are two different things. Now, the shareholders do not have a contract, but of course, they still want a return on their capital, and so this return can take three different forms. First of all, it could be paid out as dividends. That is, the firm cuts a check to each of their shareholders, it sends it out, and the shareholders have their return. Or they could do share repurchases. In this case, the company goes into the open market and buys their shares, thus reducing the share count and therefore increasing the price of the stock. So in the first case, the dividends represent a direct cash payment, and in the second, the share repurchases represent a capital gain. Now, one other way that possibly a capital gain could be earned by the investors is by the company reinvesting the earnings back into the firm, presumably into positive NPV projects. That will cause the value of the firm to grow over time, creating capital gains. So the important point here is that dividends are only one way that the firm can reward its investors or its shareholders. Share repurchases and reinvesting earnings into profitable projects are a couple of other ways. So again, the question is, why pay dividends? Now, of course, the company can do any combination of dividends, share repurchases, and reinvested earnings. So are dividends then the best way to reward shareholders? Well, probably not, but let's look at this in a little bit more detail. As we've seen, the shareholder returns are made up of a dividend yield and a capital gains yield. So what I've done here in this equation is I've taken the constant growth dividend discount model, which remember is only one model that can be used to value the stock. So this does not necessarily imply that the value of the stock depends on the dividend. Remember, ultimately, as we talked about in Chapter 8, the value of the stock is the present value of the total cash flows that the shareholders receive. But from the dividend discount model, we can solve for the cost of equity, the case of S, and you can see we have D1 divided by P0, that's the next dividend divided by the current price, that's the dividend yield, plus G, which is the growth rate, that's the capital gains yield. And so really the question ultimately is, does it matter if the entire return is dividends or the entire return is capital gains or it's something in between? So what are the advantages and disadvantages of dividends and capital gains? Well, dividends have the advantage of being paid out. So in some sense, what that means is once you have that dividend in your possession, the company can't take it away. And that makes it seem, at least, safer than capital gains. On the other hand, dividends have the disadvantages of being taxed at a higher rate. And we'll talk about that more here in just a second. And all of the shareholders must accept the dividend whether they want the cash or not. Note that that's true even if you're invested in a company that offers a dividend reinvestment plan. So in that case, you wouldn't get a check, you would get more shares, but it still counts as a dividend and you have no choice but to take it. Now, capital gains have the advantage of a lower tax rate. And let's talk about this for just a second. So in many countries, including the U.S. historically, capital gains have been taxed at a lower rate than dividends. Dividends were generally taxed at ordinary income tax rates. The purpose of this distinction is to encourage investments in companies, right? That's why capital gains were taxed at a lower rate. But even without that, shareholders have the opportunity to defer capital gains. So just because I've earned a capital gain, in some sense, I don't have to take it. And if I don't take it by selling the shares, then I don't have to pay taxes on it. And in fact, I can never sell the stock. And if I do that, my heirs will receive it. They will get what's called a stepped up basis. And if they sell the stock immediately, there would be no capital gains tax because there would be no gain. So the tax rate on capital gains can be as low as 0%. But in any case, I can defer it, putting off having to pay those taxes. Also, another advantage of capital gains is that the shareholder has a choice. They can either sell the stock and take the gain, or hold on to the stock and not recognize the gain until some later date. They don't have that choice with dividends. The disadvantage of capital gains, of course, is that they can disappear with no notice, right? If the stock price goes down, you've just lost your capital gain. This is why capital gains are sometimes referred to as paper gains, because until you sell the stock, you only have a gain on paper. Now, let's talk about the three major theories of dividend policy. And so the very first one, there was work on dividends prior to this, but this was the first rigorous theory on dividend policy, was Miller and Modigliani. Now, this is the same M&M that we talked about in chapter 16, only this time it was Miller and Modigliani instead of Modigliani and Miller. So in 1961, they wrote a paper where they claimed that the firm's dividend policy is utterly irrelevant. Now, remember, in chapter 16, we talked about the M&M capital structure theory, and what did they argue then? Well, they said capital structure is irrelevant. So this is a similar argument. What they're saying, in effect, is whatever the company decides to do as far as capital structure and dividend policy, it doesn't affect the value of the firm. That's what we mean by irrelevant. So just as with capital structure, M&M had to make several assumptions in order to come to this conclusion. If you accept their assumptions, you have to accept their conclusion because they proved it mathematically. Now, these assumptions pretty much are the same ones that they made for capital structure theory, but we'll go through the major ones here. No taxes and no transactions costs. Again, what this does is this allows the market to function perfectly so that if there is a price discrepancy, it can be eliminated very, very quickly through the arbitrage process. They also assumed all investors have the same information and draw the same conclusions. This, again, is known as homogeneous expectations. And they assumed that one clientele is just as good as another. Now, what they meant by clientele is that there are some investors that want dividends and other investors that prefer capital gains. So those are what they refer to as clienteles. And Miller and Modigliani argued that one clientele is just as good as another. There's no advantage to the firm from having shareholders that prefer dividends or shareholders that prefer capital gains. Now, one of the main arguments here is that investors can create whatever dividend policy they want regardless of what the firm does. This is similar to the homemade leverage argument that we made in chapter 16. So the idea here is that if an investor doesn't want or need a dividend and the company pays one, they can simply take that dividend and use it to buy more stock, thereby converting that dividend into a capital gain. Now, remember, they've assumed no taxes and no transactions costs. So if the company pays a dividend of $100, that entire $100 can be put right back into the company. Now, if the investor wants a dividend, but the company doesn't pay one, and there are many companies that don't pay dividends, then what they can do is sell some stock to create the cash flow that otherwise would have come from a dividend. So effectively, as long as there's no taxes and transactions costs to eat away at these cash flows, the investor can create whatever dividend policy they want, and therefore dividend policy is irrelevant. Now, one other point here is that the value of the firm depends only on the capital investment decisions made by the firm. The level of dividends should not affect the investment decisions, because if the firm pays out, say, 100% of their earnings in dividends, well, they can simply go to the capital markets and sell more stock to get money to reinvest. So there's no reason why the investment policy and the dividend policy, at least according to Miller and Modigliani, should matter. Now, a second theory, and this is due to Gordon and also John Lintner, they argued for the fact that dividends are less risky than capital gains. This is known as the bird in the hand theory. You know the old saying, a bird in the hand is worth two in the bush. And so they argued that dividends are less risky than capital gains. Therefore, the cost of equity for a firm that pays a large dividend should be lower than the cost of equity for a firm that pays very small or no dividend. And remember that if the cost of equity goes down, maybe because the firm increases its dividend payout, that should cause the value of the firm to rise. Now, why are dividends less risky? Well, as we said before, once dividends are paid, they can't be taken away, unlike capital gains, which can disappear at the drop of a hat. And secondly, we know that firms are reluctant to cut their dividend. So once a company starts paying a dividend of, say, $1 a share or whatever it is, they're very hesitant to ever cut that. Instead, what they try to do is maintain that dividend until they have excess cash flow, and then they can increase the dividend to a higher level that they think they can sustain in the long run. And so when firms cut a dividend, that's taken by the markets as a very negative signal. So because of these two things, dividends can be perceived as being less risky. Now, the third theory has to do with taxes. And this is what I mentioned earlier. Capital gains taxes tend to be lower than ordinary income tax rates, and historically at least, dividend income was taxed at ordinary income tax rates. And so from a strictly tax point of view, it would make sense for investors that have to pay taxes to prefer capital gains. Those that don't pay taxes might prefer dividends. Now, under our current tax code, there is such a thing as qualified dividends. And it's a little bit complicated, but basically qualified dividends are dividends that are paid by a U.S.-based firm and meet some other criteria. But qualified dividends are taxed at the same rate as capital gains. However, as I mentioned, effectively, the capital gains tax rate could be as low as 0 because you can defer or maybe never take the dividend and therefore never have to pay taxes. You don't have that choice with dividends. Now, there are some investors, pension plans, universities, labor unions, people investing through their 401k that do not pay taxes. And so it's entirely possible that they might buy the bird in the hand theory, or what Miller and Modigliani called the bird in the hand fallacy. Now, let's look at these 3 dividend policy theories graphically. Hopefully this will help to make some sense. So we said that M&M said dividends are irrelevant. Gordon and Lintner said dividends are preferred. And Litzenberger and Ramaswamy said capital gains are preferred. You can see the problem here. These 3 theories contradict each other. M&M said dividends don't matter. Gordon and Lintner and Litzenberger and Ramaswamy said, oh yeah, they matter, but in opposite ways. So here's what's going on from a cost of equity point of view. The bird in the hand theory, the bottom line there, says that as the dividend payout increases, the cost of equity decreases. And remember, that will increase the value of the firm. M&M, the red line in the middle, says it doesn't matter what the dividend payout is. It doesn't affect the cost of equity at all. And then the tax preference hypothesis says investors prefer capital gains instead of dividends, and so as the dividend goes up, the cost of equity goes up as well, causing the value of the firm to decline. And here's what the value of the firm graph looks like. Notice that this is the same graph, it's just with the lines flipped. So bird in the hand says the value of the firm will go up as the dividend payout goes up. M&M says the value of the firm doesn't change as the dividend payout changes. And the tax preference hypothesis says as the dividend payout goes up, the value of the firm will decline. Now, just like with capital structure theory, there are other things that we need to consider. One of these things, which I didn't list in the list here, but one of these things is that capital structure theory is very difficult to test. You can imagine doing a medical study, for example, and you want to see if some disease is caused by behavior or genetics. Well, one way to do that is to look at twins, because twins are genetically identical or at least very similar, and they were probably raised in the same home, but they may have different behaviors. And so you can test to see if one gets the disease and the other one doesn't. And if that's the case, it's probably not genetic. Well, we would like to do the same thing with companies. Unfortunately, and it's the same problem with capital structure theory, no two companies are identical except for their dividend policy. And so it's very difficult to test these dividend policy theories. Now, that said, lots of people have done it, and it seems like they all come to different conclusions. So the dividend policy theory is kind of a mess. So we know that risk and taxes are probably important factors to consider, but there are other things going on as well. So we should think about, just like with capital structure theory, asymmetric information and signaling. So the idea here is that dividends don't lie. And so when a company increases its dividend, that sends a signal to the market that this is a financially strong company that can afford this higher dividend. And if that's true, then when the dividend increases, that should cause an increase in the value of the stock. Not necessarily because the dividend went up, but because management is saying, hey, this is a financially strong company. Now, we also know that a cut in the dividend generally results in the stock price falling, because that sends a signal to the market that the company is financially weak or troubled. So signaling and clearing up asymmetric information, I think, is an important factor. Then there are also agency costs. So the idea here is that if the company has a high dividend payout ratio, that leaves less money for management to misinvest. So one of the things that we know that managers, especially at large companies, have a tendency to do is what you might call empire building, right? So they have this, that their self-esteem and the respect of their colleagues and so on can depend on how large of an organization they oversee, and that can cause them to go out and make negative NPV investments with the shareholders' money. And by limiting the amount of capital that they have access to, presumably you can reduce or eliminate agency costs. And so that maybe is another factor. Ultimately, I don't know the answer. However, my sympathies lie with Miller and Modigliani. In other words, I suspect that dividend policy, even though it might matter a little bit, really ultimately doesn't matter very much. Now, I'm not going to go through the mini case in Chapter 15 because there's really nothing in there to calculate that is relevant to what we're doing here. And so there's no spreadsheet this week. So that'll do it for Chapter 15. It's a short one this week. I hope that you found it to be useful.